All right,
Chase, I
thank you.
think Anthony is the only guy in all of higher ed, and especially in law schools, that has his own venture fund. So it's pretty exciting.
Thank you. No, thrilled. Thank you, Jerry, and thrilled to have Chase and you here. We'll get started. I know some of folks will be joining in. Louisa, thanks for saying hello. Hi, Nelson. Hi, Dennis, and hi to everyone else. And yeah, welcome to our first event for the Venture Fund at NYU Law this semester as we begin a new academic year. Hopefully you all can see my screen. I'm just going to share some quick info on who we are and what's coming up, and then we'll get started with our event. So just really quickly, I'm not going to read through this, but just so all of you are aware of who we are, we're a venture fund at NYU Law, and our goal is really to bring together our community of students, of alumni, who are either VCs, entrepreneurs, or sit in a legal function at a startup. And we do that through a number of different ways, certainly events such as this. This is the first of several events we're going to do this semester and throughout the next academic year. We also have some funding opportunities for current students. So if you're a current student, you could certainly explore our summer internship program if you are a 1L, or if you are any year within the JD or LLM program, think about participating in our business plan competition. If you are a recent grad of NYU Law and you're at the seed stage, you're looking to raise funds at the seed stage, you can also apply to get an investment from our funds. So would love to talk to you about any and all of that. And as you can see here, we also offer mentorship opportunities and other connections that you're looking for. Really quickly, want to just tell you about two upcoming events, one that's happening within the NYU ecosystem, and then one that's actually happening here in New York City. So in fact, next week, we have our annual Entrepreneurs Festival. This is a gathering of all students and our graduates across all of the different schools at NYU. For those who are here on campus, who are students, you can go and attend some sessions in person. And then we'll have a number of sessions that are virtual as well. So please check that out next week. And then as you can also see here, we've got New York's FinTech Week. So a lot of exciting events happening across New York City for those interested in the FinTech space the following week. And with that, I just want to say again, a huge thanks to Chase and to Jerry. Will, who is one of the co-leads of this social enterprise and startup law group, will officially introduce them, but just wanted to say thanks to both of them for agreeing to do this. We're really excited to hear you both talk about the relationship between founders and VCs. Jerry, in fact, did an event with us last year, and Jerry will, I'm sure, touch on his time at law school and how he started Evisort, and how Chase and him got connected and all of that. So with that, I'll stop sharing my screen and I'll hand it over to Will to introduce our speakers for today. Thank you, Will.
Thanks, Anthony. Hi, everyone. I'm Will. I'm one of the co-chairs for the Social Enterprise and Startup Law Group here at NYU. We're really interested in this event and well, looking forward to it. Our first speaker we have here today is Jerry Ting. Jerry is the founder and CEO of Evisort, an AI-powered contract analytics platform that is backed by Microsoft, which helps automate contract review and management for enterprises like Microsoft, BNY Mellon, NetApp, and Keller Williams. Prior to founding Evisort, Ting had professional experiences in banking, consulting, law, and tech sales at companies such as Credit Suisse, the Boston Consulting Group, Fried Frank, and Yelp. Ting is a graduate of the Harvard Law School and the University of Southern California. He is also a member of the Forbes 30 Under 30 list, as well as the Silicon Valley Business Journal's 40 Under 40 list. Our second speaker is Chase Roberts. Chase is a principal investor at Vertex US, which he joined in 2019. He invests in founders building software companies that follow new behavioral trends in the enterprise, such as the rise of data consumer or developers as buyers, and that which is delivered in a fundamentally new way, such as via API or as open source. Chase also focuses on all things data. Prior to Vertex, Chase led large technology partnerships at Segment and also helped launch Segment's startup program, which gives thousands of startups access to the tools and knowledge necessary to implement data analytics in their products and growth strategies. He holds an MBA from the University of California, Berkeley Haas School of Business. We are really looking forward to this event, and we're so lucky to have them both here today. Thank you so much.
Thanks for the introductions. if my parents knew that I was going to be one day speaking in front of a law school, I think they would have been very proud. So thanks for having me.
Yeah. And I think if my parents knew that I was going to go to law school and not practice law, they'd be very not proud of me. But given how well Eversource's done, it's been a good excuse. I know there's a lot of students at NYU and law schools more broadly who went to law school because you wanted to practice and build your logical reasoning skills and your advocacy skills. But you're also curious about different career paths that may be available to you. When I was in law school, and I'm a recent graduate of HLS, I feel like when I was in law school, there was a lot of pressure to just stay on the escalator of, go to class, read books, go to OCI, and then work at a big law firm. And a lot of my friends, including ones that went to NYU for law school, are now several years out into that journey of being a big law associate. And now they're still asking questions of, can I go into consulting? Can I go into investing? Can I go into banking? Can I, if they wanted to dream a bit, become like Chase and work in venture capital? So part of the goal of this program and part of the reason why Chase and I are here is so that we can talk to you about what does it actually look like to work in, I think for me, legal adjacent industries. We do, I'll tell you a little bit more about what Eversource does in a moment. But my hope is also that you'll learn how Chase and venture capital works and the relationship between folks who operate businesses day in, day out, and how they work with their board members and investors like Chase, because that relationship, I think, is a very special one in the world of business. And hopefully today we can give you a bit of sense of how that works in reality.
He's so charismatic. Now you know why he's the CEO, right? This guy's going to be standing on the stock exchange. So you mentioned something up front about like taking a non-traditional path. So before this, I actually looked up some stats from your alma mater law school, and I learned that 61% of grads joined prestigious law firms, 18% earned a judicial clerkship, 11% went to public interest professions, 4% in-house, 4% in the gov, and 1% in education. I didn't see a bucket there for starting companies, but I did find a stat from Forbes that says 90% of startups fail. And so it sounds like the odds were against this decision from day one. Like, why start a company?
I didn't go to law school thinking I want to start a company. It was never actually the plan, right? I think anyone that says I want to start a company and they don't have an actual idea for the company, those people usually don't start companies. I think there's a high correlation between that and people who instead, I think most of the founders that I meet, they're going through their day-to-day, they're going through their work, and they realize, wow, there's something fundamentally wrong with the world as it is today. There's something about the way that we're doing work. There's something wrong with the way that we're being managed or a process that we're a part of. And they get initially frustrated by that. And then they start to think creatively and innovatively about how do I solve those types of problems? And then they start companies from their own experiences. And I think that's the case for me as well, right? When I was in law school, actually as early as 1L, when I learned how to Blue Book, I thought, wow, that is a very poor process. And Chase, just so you know, Blue Booking is this very, very manual process where if you want to reference a case in a piece of paper, you have to like basically pretend to code, right? It's like the court name period. I obviously forgot how to do it because it was, I didn't realize that important to be candid, but there was like a very prescriptive way of how to reference a case. And there's a whole book that was published on how to do that. And coming from Silicon Valley, I was shocked by that because I'm used to engineers doing that kind of work so they can automate processes. So that was like the first moment where I said, wow, this is not really what I was looking forward to. And then you fast forward to my 1L summer, I was lucky enough to work at BCG as a consultant, right? So I early on started exploring already on, I know I'm in law school, but what are things I can do that, law school as a platform enables me to do? Working in management consulting was one of those things that if it wasn't for law school and an advanced degree, it wouldn't have been available to me coming out of undergrad. And then that's the funny thing is that this entire process in my first year of law school, just like SCSL, I was a part of a program focused on entrepreneurship. That's actually where I met my co-founder and he became my CTO. So for me, it's when people ask me, hey, you're not a technical founder, how do you meet your technical co-founder that can code and build AI? And I'll quickly talk about what Eversort does. It was because I was actually already part of entrepreneurship programs like SESL that gave me networking opportunities to be at the right place in the right time.
Well, so that's actually probably a good segue into how you think about the future. So Mike Maples once said that startups are bets on how the future will unfold. What is Eversort and what is the bet that you're making on the future?
Yes, Eversort is actually very simple, right? If you think about it, every time a company sells something, buys something, hires somebody, opens a new office, right? And there's a lease, there's a contract underlying that relationship. But the crazy thing is, and I think a lot of lawyers and law school students in the room know this, is that most contracts are read manually, right? The average contract gets read manually 7 times in the same company, at least. It gets read by the salesperson that creates the proposal. It gets read by their sales manager. It gets read by the customer. It gets sent back. It gets red lines, right? Then your legal team gets involved. And then before it's all said and done, finance needs to approve it. You sign it. Then accounting and APAR needs to read it. Customer success needs to read it to support the customers or customer support. At the very end of that, you have the renewal team that comes in and tries to get additional value from that account, right? That's all being done manually, right? And so when I was a lawyer, I thought about that and I said, that's incredibly odd that like in an M&A environment, you would pay big law firms hundreds of dollars an hour to go through and read old contracts. And then once the M&A is done and the company needs to be operated, you delete all that data and somebody has to reread those contracts and put them into usually an Excel spreadsheet or some sort of manual process. And so what Eversort does is we automate that entire process from the very beginning of creating the first contract draft and putting together a best first draft based on pre-approved clauses to helping with the negotiation process with your counterparty to getting internal approvals done, all using AI and being able to automatically use artificial intelligence to pull out key provisions like indemnification clauses, limitation of liability, and also operative terms for things like supply chain and vendor management. When does the contract expire? Who do we have to pay? How much do we owe them? And when do we have to pay them by? These are all really, really valuable data points that historically lawyers have read, but other business folks have also read, but it's being done in very much data silos and very much done manually. And so as a JD, and as I was sitting there, I wondered, did I spend all these years in law school and taking the LSAT and undergrad and all the things I did before so that I can manually read documents? The answer was no, right? I went to law school because I wanted to advise clients, entrepreneurs, venture capitalists. I wanted to work at a technology law firm. So Chase, to answer your question, I never thought about starting a company when I went to law school, but it was because of this really, really large opportunity that was in front of us that I thought, let me try my hand at entrepreneurship.
I think, it's funny. I think about that opportunity and a statement that you made to me when we first met, which is, if you think about every time money changes hands, anytime there's a transaction, especially in a B2B setting, there's a contract that stands behind that. Some cases it's got standard terms, but many of the times it doesn't. And I think it was that statement that really crystallized, like, okay, that there is something here, because if we believe that more transactions are going to happen in the fullness of time, and there are going to be more contracts behind all of these transactions and all the relationships between businesses, the pains of managing those in a digital environment is just going to compound. And and I think thinking back to those early days, like what was it like starting a company? Like, what were the first couple of years like as you're just getting started?
So when I was going through it as a first-time founder, I thought I was coming up with the process of starting a company because I was learning on the go. And then I quickly realized that there's a lot of people who've done this before, right? Like there's hundreds of startups that get created every year. So what I started to do was I started to take my business needs that I had in front of me, compare it with broader trends, and start to say, hey, how do we actually operate this professionally? And so the first thing I had to do was find somebody that could code, because I'm not an engineer, right? And so it's hard to build a technology company, especially one that uses AI, if you don't have a data scientist. So the first thing you have to do is you have to recruit a co-founder, right? Because I think an idea with one person is still an idea, but an idea with a co-founder, you actually have your first investor. It's your business partner. And then what we did is we went out, and this is something that I think we did well. Before we wrote a single line of code, which I think is the common mistake, right? A lot of technical founders the first thing they do is let's code it, see if it works. The problem with that model is maybe nobody wants to buy it, right? Even if it does work, if it doesn't make business sense, it's not a venture capital backed startup. And so what we did was we called 100 customers. We called law firms that were large in the AM50. We called law firms that were small and medium sized. And what we quickly learned is that law firms don't want to buy the software. And it was a little disappointing to me, right? Because a lot of my friends and mentors were in big law firms in New York in particular. And that's where I was going to be working the following summer. And so what I realized is that law firms, because of the billable hour model, they have some incentives that are opposite to maybe incentives of in-house counsel, right? So we started calling in-house counsel, and here are some people who they're incentivized to be efficient, right? Because they're part of a broader business, and it's they're not working the billable hour model, right? So whether they leave at 7 o'clock or they leave at 6 o'clock, leaving at 6 o'clock, everybody is happier for that. And I think that's a better work-life balance. And so we started talking to a lot of in-house counsel. So our first, now we have over 150 customers. It's almost exclusively people that have either had some experience in corporate law firms and went in-house, or it was in-house legal departments that are looking to drive better partnership with sales and procurement and other departments. But it was those first 100 sales calls that I made that quickly taught us from a market research perspective, hey, the initial assumption in the business model was actually wrong. You got to go slightly next door to their neighbor, and those guys, they're looking for what you're building. And Chase, I think maybe just real quickly before we get too deep into the entrepreneurial journey, I'd love to learn more about you quickly from a biography perspective, and what is Vertex Ventures and what do you invest in?
Oh man. So my background, I grew up in a small town in Oklahoma. And so this world of entrepreneurship was like totally foreign to me. In fact, entrepreneurship where I grew up was really defined by, starting a hardware store or owning a local radio station or being a car dealer, because these are the people who are like central to the community. And that was how I thought about entrepreneurship. And, as a good little Oklahoma boy does, I went to University of Oklahoma for my undergrad and studied finance. Longer story around how that decision was made. And after school, that led to a job at a private equity and venture capital fund of funds. And quite frankly, the way that I chose that job was I heard a lot of people start saying the words a lot of smart people saying the words private equity and management consulting. I was like, okay, this is where I need to go submit job applications. And at that first job at a fund of funds, my job was to research investors like us. And, whenever folks like us raise money to go invest in companies, we have to go raise money from other people. And we were one of the sources of that capital. And that's where I got introduced to venture as an asset class and basically, tech-based entrepreneurship. And I would say it was like through that experience that I also, started to become more like nominally aware of Silicon Valley as like a culture and, as an idea of entrepreneurship. And I just realized that like, there's such a different scale here that is now made possible as a result of technology. Instead of starting, I say just, but my dad was a car dealer. Instead of starting a car dealership, you can create like an online marketplace for cars. So it's like, whoa, this is crazy. And so I think that was my appetite for Silicon Valley. And so I bumped around finance for a little bit more, and then realized I didn't want to move numbers around spreadsheets for a living, and decided to move out to the Valley and join a software company. And I ended up doing so on the back of a cold email. I had read a book by a guy named Clay Christensen called The Innovator's Dilemma, and I found a video of him speaking at an event for a software company called Box, and I'd never heard of Box. And I ended up learning more about the company, discovering the CEO, and decided that was an interesting company. So I sent a cold email and ended up joining Box early in the journey. Spent half a decade there on the go-to-market side. So roles all the way from an SDR to carrying a bag, and then eventually running some partnerships, and got to see what it was like to go from small private to big public company. And after that, I went to a software company called Segment, where I built out the BD team, and then got into venture a couple of years ago. And so now I'm at Vertex Ventures. We're an early stage venture capital firm, which means that we invest in companies at the seed and Series A stages. Writing checks somewhere between $500,000 and $10 million, and basically I wake up every day trying to figure out ways I can help entrepreneurs like you and get to know more of them. And honestly, it's been quite a fun journey along the way.
Yes, I think maybe a question that is in a lot of folks' minds are like, VC is this prestigious. It's the, you're in movies and there's books written about you, but like day to day, what do you do exactly? And I think a lot of people don't know that, including me when I started a company, right? But the image was like you have this giant bank account and money just flies out of it. So, like, what do you do exactly? And tell me about the practice of venture capital.
So I'd say like the job of a venture capitalist falls into three buckets. It is finding companies and then trying to deploy capital into those companies. And I deliberately chose the word trying and then come back to that. Working with those companies once you've invested in them. So, trying to be a partner to entrepreneurs as they're, working through some of these early stages and, trying to build something great. And then the third bucket is, we've got to raise money to invest, and we've got to make sure that our investors, which we call limited partners, are aware of what's going on and excited to work with us. And so it's focusing on those relationships. And going back to the first bucket, which is, I would say, probably 50 to 60% of the time, at some point, it's trying to develop a prepared mind so we can be dangerous enough to invest in certain categories. So like, fortunately, I spent some time in and around the whole contract management space, given my experience at Box, and I continue to dig into this category, thinking about how could be reinvented, such that I could discover a company like Evisort and think like, okay, I think that there's something unique happening here, and I think that their vision for the future is potentially the right one. And then there's the process of making an investment, and presumably whenever an investor finds a great company and gets to know them, there's probably other investors who have drawn similar conclusions. And so, as you get to the end of the process, the table turns a little bit, where all of a sudden the investor is selling their money. Because last time I checked, all money is green, to founders and entrepreneurs. And that's where I would say that's where like the magic of venture really happens, which is like, what is the story that we're able to tell that could cause founders to want to work with us, and what can we uniquely bring to this firm to help them succeed? And I would say in the case of Vertex, and I'd actually love to get your reaction to this. We're a group of operators, and in the case of my three partners, founders turn investors. And so they've started 6 companies between them, and they've had a handful of meaningful outcomes there. And I think that gives us some experience that's relevant to entrepreneurs, and a lot of founder empathy for what it's like to be sleeping in the computer lab as you're building your company and eating ramen noodles. A lot of that empathy is there, and so what we're ideally bringing to the table is some of that experience, so we can help you build build the company you want to build.
Yeah, I think for me, and this kind of gets into the title of the event, I've raised 4 rounds of funding, totally over $55 million. And that number is going to go way up as the coming years come. At every round I raised, I learned something new about myself, Evisort, the industry that we're a part of, and also how venture capital works, and how to best partner with VCs, right? And Vertex, I think, is a unique fund. But when I meet a lot of different funds, for me, it's actually really hard to tell them apart, because to Chase's earlier point, when you're a company that's doing well, VCs, part of their job is to find good investment opportunities for their investors, right? And so they're reaching out to you if they feel like you're doing well. One way, by the way, that they know you're doing well is how fast you're growing your employee count on LinkedIn. I found that out because we had dozens and dozens of emails, and I started to ask them, hey, how did you hear about us? When I raised with Chase, I think we were like a 30-person company, or even smaller than that. Yeah.
Yeah, smaller than that. I think it was like 16 maybe, or somewhere in that range.
16. Yeah. I've been so busy, I forget like when we actually met. Now we're about 140 employees, and so I'm thinking that's a long time ago. And I back then, even, right, we were like a 16-person company. I was just sitting in my office doing my work, trying to get customers, trying to build AI. And VCs will come and find you, right? And there's younger VCs that the job is to kind of go out and try to build relationships. And it's really, really hard to tell like the difference between firm A and firm B there's these mega funds where they're brand focused, and maybe some of them you've heard of, but the majority of VCs, I'll say 80% of the VCs in the Valley and more broadly, there's a lot of new funds, especially at the seed and in the Series A stage, right? And some of the bigger firms that you guys have heard of, they actually do later stage deals, right? The seed and early market has become its own sort of pocket of private capital. So I think for me, to answer the question, Chase, you asked earlier, it was about the relationship, right? Because as a founder, the company is so near and dear to your heart, right? It's me and my co-founders' babies, we joke, right? And we came from an idea to all the way to putting on his first pair of pants and shoes, and now it's growing up to become a teenager, and I think soon will be like an adult. But it's really personal to you, right? And when you go out and you want to raise money and sell a part of your company to an outside person that you're just meeting over a fundraising process, it's an intimidating process, right? And I, through the hundreds of fundraising meetings I've been through, I've learned that there's some VCs that are there that are more financially driven, and there's no there or that. That's their model and that's the type of firm that they're building. And there's other types of firms that are more relationship driven. And I think for me in the early stages, I was focused on relationship driven firms because I knew that building a startup, there's peaks and there's valleys, right? And if everything has to fit into a spreadsheet early on, then that might be right for some of my friends and their companies, but not right for us. And I think when I met Vertex, the thing that was overwhelming from that firm was the incredible human connection that we had. And I think that part of that was because the GPs and Chase in particular all come from operational backgrounds. They weren't thinking about Eversort as an investment thesis only. They weren't only thinking about us as a large market growing quickly and what percentage of the market we can capture. They're thinking about how can they work with us to actually build a company that's transformational, that's generational, and what are the building blocks, including things that might not go well. How do we work together through that entire process? And I think at an early stage startup, that's what you need, right? You always have the banker types that have a lot of capital to deploy. For me, that's a later stage investment. In the earlier stage, the fact that Chase had been a salesperson at Box when Box was a smaller company, the fact that he and I can sit down and we can be friends with each other and actually have trust and build a deep relationship that has lasted many years around, hey, what's going well, but more importantly, what's also not going well. And being able to feel like I can bring that conversation to Chase and the other venture capitalists that I work with is an incredible privilege. I have founders and I do some angel investing on the side where they feel like the board and the people that are on that board have to be managed. And you have to tell them only good things and the bad things you need to solve internally. And I think that that's one way to do it. I'm not saying that's wrong, but it's not my preferred style of partnership.
Yeah, I mean, I can't emphasize that enough. I think the trust word you used just a second ago is one of the most critical aspects of it, because I think whenever, like, one, you have to trust that I'm always going to be as discerning and some of the things that I'm saying and looking out for like the best interest of the company whenever we're working together, and then you also have to trust that like there's a safe place to say like, hey, here's something that's not going well. Like we need to work through this. And I think that, to your point, some founders think like, we'll look at their board as like, hey, I've got to put on the best picture. Yeah, I've got to put on my tux, walk in, and be sharp. And that ends up being a recipe for disaster in the long run, because eventually you start painting a brighter picture than that isn't reality to your investors. Eventually you start to believe in it yourself, and you start to overlook some of the critical aspects of the business. And then from the trust standpoint, like if I come to you and I'm like, hey, here's a candidate you should be thinking about, or I think that there's a particular competitor that like we're just not paying close enough attention to, or we're moving not quick enough in this area, like you've got to be able to like say like, okay, actually this judgment is useful, and I actually will take this into consideration as I'm making my own decisions as a founder.
And I think that that's really rare, right? And the board dynamics is something that for lawyers actually is really important, because as you counsel companies and you think about, so Cooley is my outside counsel, for example, they come to my board meetings, right? They take minutes, they do board approval procedures and board actions. And so the legal part is a piece of the board function. But I think the better part of a board function, especially for private companies, is using the experience of the board and the different individual members and using that to help solve business problems. One thing that I'll say about Chase and what he's done for Eversort, and I'll say done for me, is he's helped us recruit some incredible salespeople. Right, he's had that network in the Bay Area. He was at Box early, and met a lot of great people that are good at enterprise sales. And that's an example where a venture capitalist takes off the investing hat and actually takes on what I think the majority of a role of a VC is, which is the 80% of time you spend outside of investing with your portfolio companies between deals. And I think that's where you separate the really good firms and the really good investors and board members from the people that are more capital partners, right? Capital partnership is definitely a piece of the venture capital business. But when you're actually, once you raise the money and then you have to invest the money, and you're making big decisions like, do I want to spend a couple $1 million more in engineering? Do I want to spend it in sales and marketing? Those types of questions, if you're a venture capitalist and you've invested in dozens and dozens of companies, you are recognizing patterns, right? You're able to counsel founders and CEOs, maybe not tell them what to do, but say, hey, have you thought about this? Have you thought about that? That assumption you made, what do you think about this? And Chase, maybe that's a question that I want to ask you is when you maybe disagree with founders or you want to ask them to double check an assumption, what are some skills that you picked up, tips of the trade, so to speak, to do that in a way that's collaborative and constructive versus, I've heard horror stories in the Valley of board members that take a more authoritarian type of approach.
There's not a perfect answer. I think that in general, a VC should always start with the assumption that they have much less context about the business and the problem than the entrepreneur who lives it every day and all day. And yes, we do. We try to stay close to companies and feel like be close, like understand what's going on with the business. But at the end of the day, like you will always have more context than I do. So I kind of start with that assumption. But then I would say that in general, it's like it's not. Like we don't see our role as like overruling the founder if they think they're wrong, no matter how certain we are in that in that assertion. I think that in general, our goal is to help you fail quickly. So if there's something that you want to try and perhaps we disagree with it, that's okay, well, what tools can we give you? Whether it's okay, how do we define success for this decision? How will we know if it was the right decision, and when how quickly can we know that? And just ask questions like that. That way you can figure out very quickly, more quickly than perhaps otherwise without that framework, that it was a good decision or it wasn't a good decision. I would say in general, we won't let you make existential decisions. So if you're hey, I'm gonna just turn off this contract, intelligent contract management thing, and we're going to go focus on this. And that's probably where it'd get a little bit harder to, work with that approach. But I would say in general, founders are very discerning and those existential decisions aren't as common. And then I would say in general, one good tactic is, I would say that it's kind of like your parents. There's things that your parents can say to you and you're as many times you say it, you don't hear it. But if someone close to you that's not a parent says it, it just kind of rings differently. And so I'd say one of the things that we also think about is where can we bring to bear our network and just see if there's opportunities for let's say for example you're making a big decision about I don't know a big hiring decision for a finance leader, and you're looking at a certain profile and perhaps it's not totally clear whether that's the right profile. Then the best thing that we can do is perhaps find someone else who's hired people in that role. It's hey, you all talk and then ask each other questions. Here's some of the questions we think you should be asking, and see if that if that helps you improve your filter a little bit.
Yeah, I've said this a lot to different folks over the years. There is a type of risk and a type of innovation risk specifically that you want in a startup. And there's some types of risk, innovation risk or figure it out kind of risk that you don't want in a startup, right? And so what are the two buckets? And knowing that, I think, is a really important part of operations. How does the AI work? How does the technology work? How do we push the boundaries of cloud computing? That's the innovation risk that you want to have, you want to push on, because that's a key part of what makes you different than some of the bigger tech companies that are less agile. What you don't want to figure out is hey, how do we come up with a random pricing model that no one's ever heard of? Or how do we go and spend a lot of money in Google Ads and actually not know how to measure ROI, right? There's people that have done those things that are really good at that, that can bring experience and pattern recognition to bear. And for those roles, I look to hire senior people who've done it at multiple different companies so that they can take the different perspectives they have, bring it to Eversort collaboratively. Let's make the Eversort best version of that, but it's informed by experience and innovation. And I think that's where a lot of founders go wrong is when they take the innovation process that they have become so accustomed to in building product, and they take it at things like legal negotiations. That's where you got to call your outside counsel, right? And that's where the lawyer fits in, right? You don't want a young founder who's never negotiated the indemnification clause to go out in front of a Fortune 500 and figure that out on the job, right? You need somebody who's done that before. So I think knowing which bucket of risk you're okay with is actually fundamental to being a risk manager as a founder and CEO. And Chase, just there's some questions coming in from the comment box. I'm going to just go ahead and open that up. The first one that I see is, let's see, when is VC not a founder's best bet? And that comes from Ed. Man, I think that's actually a great question. So Chase, I'll take that because obviously contradicts your business model a little bit, I think, but not fundamentally. There are some companies, especially companies outside of the Bay Area, that I have a tremendous amount of respect for, right? They're companies that did it, in my opinion, the old-fashioned way, right? Which is bootstrap, go several years, work in a garage, build a product, use the earnings that you make from that product, reinvest that, and you grow what I call organically, over time. Those companies, I think, are harder and harder to build, especially if you want to get to some sort of meaningful velocity. Right? I mentioned earlier that I worked at BCG. There's a famous chart. It's a 2x2 at BCG, which
There's
puts
lots
companies
of
in different
charts.
It's a 2x2 is the house special, right? That's the pepperoni pizza. And there's a phrase called a cash cow, right? And a cash cow, just so everyone knows what that's defined as, it's kind of like what Chase was talking about, right? The form of entrepreneurship that he was accustomed to growing up, which was cash flow based. You invest the earnings of the company back in the company, and you grow steadily over time. And it's a great business, right? My dad owns one of those types of businesses. But I think when we talk about startups and entrepreneurship in the Silicon Valley sense, we're looking for very non-linear growth, right? And the common nomenclature is triple, double, double. Did you triple your revenue the first 2 years? And did you double your revenue the first 2 years after that? And I think to get to that type of growth, it's harder to do without outside funding. And for reference, Eversort was bootstrapped for the first 2 years, right? We were, I and my co-founders put our own money into the company. We worked incredibly hard. But when we realized how big the opportunity was, we realized that it was best to own a percentage of $1 billion than to own 100% of maybe a much smaller amount. So that'll be my response, and I think it's a very personal decision. There's not a right or wrong answer, but there is a difference in terms of how fast you can grow on average.
Yeah, so I like the thing that I'd add is, the thing that's changed, the thing that's changed as a result of the internet is like you can build a business for everyone from a single place. And so, in the world pre-internet, and if I started a business, call it to serve people, like in my community, like I could really only need access to those people in my community, right? But when the internet, like I can serve anyone, and so then therefore, like there will be single winners in certain categories. And I think that in enterprise software, that effect is especially pronounced. And so if you look across enterprise software categories, like first place is, or I'll work backwards. Second place is usually a fraction in terms of market share of where first place is at. And then third is just like not even on the list. And then it just tails off asymptotes very quickly. And the thing that typically makes these categories is not necessarily it's not necessarily always the best product. It's like the best execution, the best market execution, and the best to really define the category in their image. And so take Salesforce as an example. Salesforce, no offense to the company, but if we look at the product, there's probably other CRMs that are much better than Salesforce out there. But at the end of the day, they have access to all of these customers that is going to be really hard to replicate. given the strength of their like go-to-market engine. And once you've established yourself in a category, when people make decisions about what software to buy, no one wakes up and says, well, I see that Salesforce is number one according to my peers, but I'm kind of curious about number two. I want to start there. Everyone says like, I'll start with number one, and that's probably fine as long as it checks my boxes. And so what venture capital does, kind of bringing it all back, is it allows you to grow faster than what you could otherwise, how you could otherwise grow without that additional capital. And the reason that's important in enterprise software is because the companies that win are the ones that kind of win the mind share, win categories, and a lot of times it's the ones who get there first. And so venture is basically a way of saying like, look, we're running toward the same finish line. I'm just trying to get there quicker than the other folks because we recognize that finish line has outsized returns relative to second and third place.
And there's companies in the world that, and I have friends who run these companies that don't want to have an exit. Chase's model, I think, is right if there's an exit, right? But there's people who say, hey, I want to just run a 50-person company. I want to grow it to 100, want to grow it to 150. But we want to work here long-term and we don't want to sell the company. We want to just operate as an independent business. That's a different choice, right? And it's a strategic choice that sometimes when I meet founders that I'm giving thoughts to, and I clearly can tell that they're in that category, not the venture category. I said, don't go talk to Chase, because those people are going to make you guys do things that you don't want to do. And if you just want to be a 10-person company and have a lifestyle business, then that's you need to decide that. And there's not a there. It's not right or wrong, but it's a personal decision for that founding management team. I think for the next question, Irene asks, and this is a good one, Chase, for both of us. I love to get your thoughts on this. When you're raising multiple rounds of funds and funding, multiple VC firms have similar terms of investment. How do you choose who's the right partner in such a short time? And what are some of the considerations behind your decision? So I think there's like three things that I look for when I look through a fund. And the things you look for when you're in your first round of funding, your second round, your third round, your fourth round, your fifth round, it's different, right? It changes over time. When you're really small, right? When you're a 3-person company and you say, hey, I just need 600K or $1 million, or the number keeps going up seemingly every couple quarters. I need $3 million to get the company off the ground, right? The firm that you want to work with there is very, very different than the firm that you want to be working with when you have product market fit and you just want to hire more sales and marketing and go try to win the category, right? So for me, when you're looking at early stage investing versus growth stage or late stage investing, at the early stage, it really is about how can you work well together. It's the concepts of trust, collaboration. When we first went out and raised funding, our product was still very young, right? It wasn't a position where we can just go and hire 20 salespeople and sell, right? And so the first couple of quarters was actually working with the early board members to say, hey, we're still building the product, but how do we start to think about how to price, how to package, how to get our website up? How do we get some of the bare bones in place before you go and hire a bunch of salespeople and see if they could be effective, right? And I think for me, when I met the early firms, Vertex being included in that category, it was a lot about the people, right? That I like the firm overall, but did I actually like the person that's going to join my board? And is that person going to be collaborative and value add? And somebody that in the early days, I was looking for also mentorship for people who've done it before at other places to teach me the stuff that I might not know, right? So for me, that was a big reason why I chose Vertex, is that Insik Ree, who's Chase's partner, there's a book out there called The Hard Things About Hard Things. And the company behind that book, Insik was a co-founder of that company, really helped build the internet age, in my opinion. And it's hard pressed to find somebody who's like that. And he has a business partner named Jonathan, who really built the infrastructure behind Facebook, right? When you have people like that who are helping you build your company, suddenly you feel not as small, right? You feel like you can do something that's pretty awesome if they believe in you, and Chase believes in you and he's helping you hire your go-to-market team. Then we're all working together to build a village that can build a company. So for me, it was about the people, their background, their experience, and also like, are they going to be detrimental, right? And there's a phrase in venture capital which is do no harm, right? And every VC laughs when I say that. Can you hit that bar and then add value on top? And I think for me, that's a pretty high bar, and I think my VCs need that. But Chase, when you guys are putting out term sheets, right? how do you tell founders that maybe are new to the fundraising process, hey, there's differences like the way maybe I described? How do you teach them that? And then how do you guys put yourself forward?
I mean, honestly, I think that whenever we invest, we have to believe that there's something about the business that we could be useful for. And so let's say, for example, a company is really strong on like product and engineering, but they're not quite as sharp when it comes to, you know, how do we take this great product that we've built and turn it into a great business? And so, you know, we want to understand like, okay, you know, can we help them solve for this challenge? And then what we're saying to the founders is like, look, we believe that you've got, you know, in this example, the best product and et cetera, et cetera. But, you know, for you to build a successful business, you have to do these things. And here's some of the ideas that we have. And then it becomes more like, you know, getting closer to doing instead of telling, like, hey, here's what we would do if we were working together with you to help de-risk this aspect. I think founders really appreciate, and you can tell me if this is the case, when their investors have a deep insight about not just what they're building, but like how they turn it into a great company. And some strong inclination to actually bring those insights to bear upon working together. And so I'd say like that I would say that's part of it. And then I would say the other thing is, you know, whenever we invest in companies, we'll literally send over a sheet with the contact information for every founder in our portfolio, or whenever we send out a term sheet, which is basically like an attempt to invest in a company, we'll send them the sheet with like a list of all the people in our portfolio. And we're like, hey, just pick anyone and call. We've got no skeletons in our closet. And we feel like, you know, that ends up being a really good selling tool as well, because, yeah, as you did whenever you selected Vertex, like you want to understand, like, are they smoke and mirrors, or are the things that they're selling, the things that they're saying about themselves actually reality? And that ends up being a really good tactic as well.
Yeah, so when we were raising our round with Vertex, we actually had at least five term sheets, five that I can remember. And it got down, and it was over like a 3-week process, right? So it kind of came, it was slow, and then it became quick, right? You know, weeks of conversation before, and then 3 weeks of fundraising, and you know, I told everybody, hey, send a term sheet this day, and they did. And it came down to 2 firms. And I think both firms are great firms, right? Vertex is not the only great firm in the Valley, right? There's other great firms. And so there's 2 great firms. And the night before I signed the term sheet, Chase was, I think, were you in Napa, or you were doing something that was a lot more fun than waiting for me to sign the term sheet.
let me actually add this anecdote. My wife and I planned a trip to Napa that weekend, and it was supposed to be like my quote unquote like birthday weekend. And it was the weekend before, and I thought we had lost it. And so like the whole time I'm kind of like a little bit pouty. It's like, I don't really want to drink. We just kind of stayed at our place. And so my poor wife had to endure what I thought was a lost opportunity, but yes, go on.
So I'm still in the Bay Area, and the Napa is about like an hour and a half away, right? So I go to dinner actually with the other firm, and I'm sitting at a dinner, and I'm looking at the person that's in front of me, and I'm wondering, you know, the average venture capital and entrepreneur partnership lasts longer than the average marriage in America. You just let that rest for a second, right? And so that says something about venture capital and about marriage in America. You can decide which one which, right? And so I was sitting here, and I was eating with this person who I have an incredible amount of respect for. And I thought back to the conversations that I had with Chase and InSync, and I said, I just don't know how to decide this. And I was completely torn, right? And so after that dinner, I was like, I just got to see the other firm one more time, right? And I just want to like put my gut forward, because all terms are great, and you know, firms are great, but like, who do I want to work with? Who do I want to get married to, right? And that's a very personal decision. So I actually called Chase's business partner, InSync, who you know, if you know Asian culture, we like to drink boba, right? And so I said, hey, let's go get boba. And it was like 10 o'clock at night, and he came out, and this, you know, incredibly successful person came out and had boba with me, and we just talked for 2 hours about how he built his company, right? What was it like it's like, I don't mean to date you, but it feels like a while ago, right? Like early 2000s or somewhat, something a while ago, you know, early 2000s, and you know, how was the internet like back then, and what was his view on cloud computing, and what did Opsware do and LoudCloud do back then. And I could tell from the way he was talking about it, this guy's walked not only 1 mile in my shoes, he's walked around the world in my shoes, right? And even taken a company public. And for me, I just felt like it's somebody that I can look up to and work with Chase, and it felt more personal. And that's ultimately how I made the decision. And that's not the answer they teach you in business school or law school, right? They teach you, hey, you negotiate the roll for rights and the drag along rights and the blah blah blah. In the reality of a deal, those things are important, but they're secondary to who's actually at the dinner table. And I think that's something that I think separates good lawyers, good VCs, good entrepreneurs, good business executives from other people, is like, how do you make people feel? And I think Chase made me feel like, he made me feel that I was actually important in a broader portfolio. I think that's a hard skill, right? And that's, a lot of VCs don't have that. So maybe next question is from Delphin. I read about tech accelerators where entrepreneurs come together and there's a training aspect. What percentage of tech companies go that route, and how does that tie into getting VC funding? I'll give that to you, Chase.
Yeah, so for the uninitiated, an accelerator is almost like a boot camp where you sign up for this boot camp, and as part of signing up, the boot camp administrators or the accelerators will take they will give you some amount of money, usually somewhere in, call it the $50,000 to $250,000 range, and for that they will take a stake in your company, so you're selling equity, and then they give you like a set of curriculum to help you figure out like, here's how to think about sales and fundraising, et cetera, et cetera. I would say that like a smaller percentage of startups that we engage with have actually gone through some form of an accelerator. That's not to say that accelerator is like a bad route. I think for a lot of founders, it's a great route. And I would say like it is a great way to jumpstart like building a quick network, because once you join an accelerator, you get the benefit of everyone else who's gone through that accelerator. And many times like there are very successful companies who have come out of that, and you immediately get access to those. And it's also a great way to like kind of demystify, the fundraising and venture capital and startup ecosystem. If it's like, if you're coming in and it's somewhat new to you, as it was to me whenever I joined. And I think that's a way that accelerators can be really useful as well. But I would say in terms of like how we think about, whether a company's gone through an accelerator or not, it generally doesn't change our calculus in terms of like, how we're thinking about that investment. But for many founders, it's a great option.
Yeah, looking at 4 minutes on the clock, I'll jump to another question that I'll help us answer. And Chase, love to get your answer too. What are the most important relationship-wise issues that startups and investors face post-deal? It's the scenarios that are in front of you, right? Where there's maybe not a right answer, but I'll give COVID as an example. We just raised a round with Vertex, riding high, right? $15 million in the bank. Microsoft was a part of that deal. Let's go out, let's go and hire a bunch of people. Let's go rock this thing. 2 months later, COVID hits. No one ever thought that was going to happen, right? And I remember Sequoia put out an article calling this the black swan event of our startups generation. The world is ending, was basically what the article said. And so as a founder and as a newly put together board after a new fundraising round, I had a lot of personal conversations with the different folks that I work with. And what we ultimately decided, and there was no right answer, right? People were saying this might last 5 years, right? You gotta save your budgets, don't hire people, fire people. People are saying all these things, and a lot of startups, including ones my friends run, had to let people go, right? Because of COVID's impact or its perceived impact in March of 2020, around that time frame. What we decided, and it was through a lot of deep conversations with the broader board, is that we're going to actually slow down our hiring, still make some of the necessary hires that we think will be remiss not to make in the next coming months. But we wanted to protect our employees and protect, at that time, cash was king. That was a phrase, right? So we had a new lease we're going to sign. This is still my older office. We haven't renewed that lease actually because of COVID. And we said we're gonna freeze the lease. We're gonna not hire nearly as many people as we wanted to. And I'm proud to say that with the guidance of my board and a lot of really tough conversations, we didn't have to let anybody go during COVID. That was what's called regrettable attrition. That's something that once you live through that, right? I think it aged me a couple of decades. But I look to the next problems that come in front of my company, and I look at the board that we work to partner with, and I realize we can go through a lot together, because that's the kind of experience that generations from now, you'll talk about that one crazy pandemic and how companies and management teams treated their people. And that's actually part of what we talk about now when I'm recruiting executives, is that we put people first over just the business. And I think if you do that, then you'll put all the priorities in place. That includes putting customers ahead of yourself, because they're also people. I think if you focus on that, you build a good business.
I think that's exceptionally said. In general, like whenever an investment gets made, you're thinking, oh, this is great, everything's going to go well, it's just going to be up and to the right all the way. But you zoom in on any company's progress, pick any public stock, and there's a lot of like down divots, on the way up. And I think that that like the best the best relationships really kind of show their strength at like in those divots, like when things aren't going well and things aren't going as expected. And then Jerry said something about like focusing on people and hiring talent. There's a common trope in venture which asks, which matters more, the team, the market, or the product? And I've come to believe, and I think I said this a little bit earlier, which is like the best products don't win markets. It's the best actually the best execution in those markets, which is actually a people thing, and that the best teams will actually find gaps in existing large markets and develop those gaps into the next version of that market, or they'll find non-consumption markets or non-existing markets and develop them into new ones. And so that's a team exercise as well. And so the thing that we're paying attention to, and the thing that I would encourage anyone who's thinking about entrepreneurship to pay attention to, is like who are the people that you're going on this journey with, and how discerning are you as a founder in not only selecting the right people, but attracting the best people to come work with you on that journey. If I have a lot of great people in a room, I believe that they can run through walls to build whatever company that they want to build. And so at the end of the day, this is like totally a people decision. People ask us like, they'll send us like, hey, is this a great idea? Should we invest? It's like, I don't know who's working on it. And I think that, you build great people, you can build a great company.
Jerry and Chase, I'll jump in on that note because we're right on time here, but I think that's a terrific point to end on. And on the people point, I should just say, both to everyone and to the two of you, Chase, I've met a few of your colleagues on the Vertex team, and you've got great people working with you, and that's really evident through everyone I've interacted with. And Jerry, I've actually met Jerry in person. We first met via Zoom a year plus ago, but I met Jerry in person, and I met his team in person as well. And the same can be said about Jerry and his team as well. Just terrific people working on an amazing company. So thank you, Jerry. Really thrilled to hear about your experiences with Evisort and what you're building and the success you've had, even in the midst of an incredibly challenging season for all of us. And Chase, quite inspiring to hear about how you and the Vertex team approaches venture capital, and love that you guys prioritize great teams and relationships. And that's evident from the conversation you two have had today. So I also just want to thank Will. Will, thrilled to have you here, and we're thrilled to partner with the Social Enterprise and Startup Law Group at NYU Law for this event. And of course, thanks to all who've attended today. As you know, this has been recorded, so we'll be posting this online in a few weeks, and we hope to see you all at one of our upcoming events. Thank you all, and have a great rest of the day. Take care.
Cool.
Thanks for having
everybody.
us.
Thanks. Bye-bye.
Cheers.
Thank you all so much.